Warren Buffett, the greatest investor who ever lived, once said that the book I'm about to talk about is, quote, by far the best book on investing ever written. That book is The Intelligent Investor, written by Benjamin Graham back in 1949. Now here's the thing, most people who buy this book never finish it. It's dense, it's old, some of the examples are from companies that don't even exist anymore. But underneath all of that, there are a handful of ideas so powerful that they've made ordinary people wealthy for over 70 years, and they'll still be true 70 years from now. I'm going to give you the entire book, the real lessons, no fluff. Let's get into it. Lesson 1. Graham opens the book by drawing a line in the sand, one that most people today have completely erased. He says there's a difference between investing and speculating. An investment operation, in his words, is one that after thorough analysis promises safety of principal and an adequate return. Anything that doesn't meet that standard is speculation. Let me translate that. Investing means you've done your homework, you understand what you own, and you have a reasonable expectation of not losing your money permanently. Speculation is betting. It's buying something because you hope the price goes up, a coin, a hot stock, a meme without any real idea of what it's worth. And here's the trap. Graham says speculating isn't necessarily wrong. There's intelligent speculation and unintelligent speculation. The danger is when people speculate while thinking they're investing. They take huge risks they don't understand and call it a strategy. So lesson number 1, before putting your money into anything, ask yourself honestly, do I actually understand what I'm buying and why it has value? Or am I just hoping? If it's hope, that's fine, but call it what it is and only bet what you can afford to lose. Lesson 2. The next idea might be the single most valuable in the entire book. Graham calls it Mr. Market. Imagine you own a share of a business and you have a business partner named Mr. Market. Every single day, Mr. Market shows up at your door and shouts a price. He'll either offer to buy your share or sell you more of his. Here's the catch. Mr. Market is emotionally unstable. Some days he's euphoric. He thinks everything is amazing and he quotes you a ridiculously high price. Other days he's terrified and depressed and he'll offer to sell you his shares for pennies. Now the key insight. Mr. Market is there to serve you, not to guide you. You don't have to trade with him. If he offers a great price, take advantage of it. If he's being irrational, ignore him and come back tomorrow. He'll be there. He always is. Most investors do the exact opposite. When Mr. Market is euphoric and prices are high, they get greedy and buy. When he's panicking and prices are low, they get scared and sell. They let his mood become their mood. Graham's lesson is this. The stock market is not a genius that always knows the right price. It's a manic depressive man having a mood swing. Your job is to stay calm, and while he loses his mind, and occasionally, to take his money when he offers you a deal. Lesson 3. If you had to summarize the entire book in 3 words, Graham said those 3 words would be margin of safety. Here's the idea. When engineers build a bridge meant to carry 10,000 pound trucks, they don't build it to hold exactly 10,000 pounds. They build it to hold 30,000. That extra capacity is the margin of safety. It's the buffer for the unexpected storm, the mistake, or the thing that nobody saw coming. Investing is the same. You want to buy a business for significantly less than you think it's actually worth. Let's say you calculate that a company is worth $100 a share. The margin of safety says don't pay 95, don't pay 90. Wait until you can buy it for 60 or 70. Why? Because you might be wrong. Your estimate could be off, the economy could turn, something unexpected always happens. That gap between the price you pay and the value you believe you're getting is what protects you when you make a mistake. And you will make mistakes. Everyone does. The margin of safety doesn't just protect your downside, it's also where your profit comes from. Buy something worth 60 cents for $1 and you're going to lose. But if you do the opposite and buy something worth $1 for 60 cents, you've built in both protection and upside. So never buy at fair value. Buy with a discount. That discount is your insurance policy against an uncertain future. Lesson 4. Graham says there are two types of intelligent investors, and you need to be honest about which one you are. The first is the defensive or passive investor. This person wants safety, simplicity, and freedom from effort. They don't want to spend their weekends analyzing balance sheets. For this investor, Graham's advice is beautifully simple. Diversify broadly, buy quality, and invest consistently over time. In today's world, that basically describes a low-cost index fund, something that didn't even exist when he wrote the book, but perfectly matches his philosophy. The second type is the enterprising or active investor. This person is willing to put in serious time and effort to research individual companies and find bargains that the market has overlooked. Here's the part people miss. Graham says the enterprising investor can earn a higher return, but only if they genuinely do the work. If you're going to be active but lazy, you'll get the worst of both worlds. There is no middle ground where you casually pick a few hot stocks and beat the market. That's the fantasy that wrecks most portfolios. So be honest with yourself. If you don't do the work, be a proud defensive investor. Buy the index and let time do the heavy lifting. There is zero shame in that. In fact, most people should do exactly that. Lesson 5. Here's a line from the book I want you to tattoo on your brain. The investor's chief problem and even his worst enemy is likely to be himself. I'll repeat that. The investor's chief problem and his worst enemy is likely to be himself. Graham understood something that took the financial world decades to catch up to. Investing is not really about intelligence. It's about temperament. The most brilliant people in the world lose money in the market because they can't control their emotions. They panic sell at the bottom. They get greedy at the top. They chase the newest trend. Meanwhile, an ordinary person with average intelligence but an ironclad discipline quietly outperformed them for decades. Graham said you don't need a high IQ to be a great investor. What you need is a stable emotional framework and the discipline to not let feelings hijack your decisions. So the enemy isn't the market, it isn't the economy, it isn't even the news. The enemy is the voice in your head that says, sell now, everything's crashing, or buy now, things are only going up. Learn to recognize that voice and learn to ignore it. Alright, let's boil this entire book down into what you can actually do starting today. 1. Know the difference between investing and speculating and never confuse the two. 2. Treat the market like Mr. Market. Use its mood swings. Don't be ruled by them. 3. Always demand a margin of safety. Never pay full price for an uncertain future. 4. Be honest about whether you're a defensive or enterprising investor and commit fully to one. 5. Master your own emotions because your temperament matters more than your intelligence. And underneath all 5 of these is one quiet idea. Think of stocks as pieces of real businesses, not blinking numbers on a screen. When you own a business, you think in years and decades. When you own a ticker, you think in minutes, and that's how people lose. The Intelligent Investor isn't a get-rich-quick book. It's honestly kind of the opposite. It's a get-rich-slow, get-rich-for-sure book built on patience, discipline, and common sense. And that's exactly why it's endured for over 70 years, while 1,000 flashier strategies have come and gone. If this helped you, hit subscribe and like this video. Drop a comment and tell me which lesson you think is most important. Now go and invest intelligently.